Nick Maggiulli, Chief Operating Officer of Ritholtz Wealth Management, creator of the popular blog of Dollars and Data, a best-selling author, and the author of the brand new book, The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. And one of the original guests on this show back in the day when we launched, you were episode 23. It is so great to welcome you back to the show. Congratulations on the new book, and really appreciate you taking the time to join me, Nick.
Thanks for having me back on, Julia. Appreciate it.
We're thrilled to have you on. And I mentioned like your first book, Just Keep Buying, was a bestseller. And I finished this one and my husband was kind of making fun of me because I had the highlighter. I'm not usually this kind of girl, but I had like the highlighter out, just going through the chapters. Really incredible read. Super excited to get into the framework with you. But on this show, I want to start where we always start. And if you are a regular watcher, viewer, or listener, you know where that is. And that's kind of with the big picture. So before we dive into the book, let's start with the big picture, your assessment of the economy, the markets, where we are today, your outlook, and the framework in which you look at the world. Let's start there.
So I don't try to follow macro too much, to be honest with you. I feel like the most important thing for an individual to do is focus on the things they're good at. And those things are going to pay off more than any sort of macro picture. So it's not to trash that whole thing.
That's all good. Yeah. But whatever
I know there's a lot of,
yeah.
because I know there's a lot of uncertainty and people just don't know the future. I've just seen it over and over. You know, if you looked at all the forecasts at late 2019, they all had very different visions of 2020 and 100% of them were wrong. And not because anyone was stupid or didn't know, like, it's just hard to predict certain things, right? And so it's not that I don't care about that. I think there's interesting things going on in the economy. I like to listen to this stuff and hear about what people say. Are we going into a recession? Unemployment numbers, things about, people leaving the labor market. You hear all the, the Gen Z's not getting jobs at the same rate. Like, you hear all these different things and some of them are concerning, but are they going to heal themselves? Who knows? I don't know. And so it's not to ignore macro, but I'm just like, I need to focus on the things where I add the most value and where I can kind of improve myself. And I know it's a little bit of a selfish take, but I think that's the thing that most people are going to be better off doing than trying to track where the S&P price target's going to be by the end of the year. So that's kind of my overall take on it. It's very individualistic, but I think it's been very helpful for me to just kind of not tune out the noise, but focus, just keep buying, get that settled, and then go and try and do something that you have an edge in.
And I think that's why your episode 23, also did really well, because you do have that perspective, that data-driven approach. I think it's a bit of a fresh perspective because you're right. There is a lot of doom and gloom out there. We try to balance it on this show and get folks who have all sorts of viewpoints. So that's why it's super helpful. You had this really great post on your blog that also relates to the book too. And that was the death of the Amex lounge. And what does that kind of say about where we are today?
So the post was about how the Amex lounge is overrun. The, hotels, you go to a nice luxury hotel and there's people out at 7 a.m. grabbing pool chairs, right? Like, cause like the pool chairs, there's not enough of them. House prices haven't come down, especially in very expensive areas. And so it's like, what's going on? And I'm looking at the data and there's just more people in what I call the upper middle class. This is what I call like level 4 of the wealth ladder, which is like $1 million to $10 million in net worth than ever before. Like in 1989, this is inflation adjusted numbers. In 1989, 7% of US households were in that bucket, level 4, so 1 to 10 million. Today, it's 18%. So that has over doubled in the last 30 years. And once again, this is inflation adjusted wealth. And so some will say, okay, well, some of that's home equity. Yes. Some of that's, retirement accounts and things. So I agree. It's not all liquid net worth, but still there's a lot of people that are in this class that are making more incomes, that have more wealth, and that are willing to spend more. And there's not enough resources to accommodate them. And that's why prices are going up or prices haven't come down and things are getting very crowded. Like, as I said, the Amex lounge is more packed than outside of the lounge, which is crazy to me. But that's the truth of the matter.
So there's like more millionaires than ever then.
Yes, there's over 20 million millionaire households.
It makes me also wonder, like, the expectations of, like, I don't know. Okay, so I was born in 1988. I think, like, growing up in the 90s, like, wow, $1 million. Like, that's, like, crazy. Like, that probably was, like, the biggest number that I thought existed when I was a kid. I don't know. But the expectations of what that means, I imagine, has changed because, as you also point out, like, the crowded Amex lounges, people scrambling to get chairs at, like, Baha Mar, whatever the hotel was that you were referencing. even like, I guess your first house too, like you might have thought like, I'm going to be able to get a mansion, but that's not necessarily the case.
Yeah, I think there's a lot of stuff going on. So it's funny because I actually wrote a post about like the rise of the millionaire as like a term in the US, and it really started to get popular again it actually got popular in the late 1800s with the whole, robber baron era and Gilded Age, all that. And then it kind of lost. If you look at like Google Ngrams, how often people say the word, and then it started to get popular in the early 2000s because there was a famous game show called Who Wants to Be a Millionaire?
Yes.
And that kind of the millionaire ideal kind of came back in like that early 2000s, late 90s era. And that's when it got popular. From then to now, so if you had $1 million and let's say, 2000, today you would need about 2 million just on inflation adjusted basis to have the same amount of wealth. But on a percentile basis, if I remember correctly, having $1 million back then was like the top 5% or something. I can't remember exactly. Today, you would need $4 million to be in that top like 5%, if I remember correctly. So it's something like that, or like that, or maybe it's the top. I think it's the top 7%. I apologize. It was the top 7%. Today, you would need 4 million to be in the top 7%. So that's the big change. And so on a percentile basis, like even though, goods have, doubled, right, in terms of, halved, I guess, in terms of value, why you need 2 million today. In terms of percentile on a relative basis, you would need 4 times as much. And so that just shows how much wealth has actually been created since early 2000 and how much it's kind of moved around at the same time.
But does that also change the perception of people's wealth? Where they might not think like, that's such a terrible thing to say, but like they might not think it is what they had expected. Then they're not getting as much as they thought then.
Yeah, I think that's a big piece of the piece. And I know it's like trust me, I understand where this is coming from. This is like first world problems, world's tiniest violin. Yeah. I get all of that. I'm just saying, imagine working so hard, doing all this stuff, saving all this money, doing this. And then your experience it's kind of ironic that your experience isn't that different from anyone else, right? Yeah. Like you're not like flying private. Those people are actually have like made it. Those are like, that's the elite upper class, which I say is over $10 million in wealth. That is a completely different thing, but that's only the top, 2% of the United States has more than $2 million. And so, I'm sorry, more than $10 million in wealth.
Yeah. Okay. So let's talk about this framework, the wealth ladder, because as you put out in the book, wealth is not a straight line. It's a ladder. And each rung of the ladder corresponds with a wealth level that will impact nearly every facet of your financial life, from how you spend money to how you earn it to how you invest it. And each level of the wealth ladder is unique. So walk us through, there's 6 different levels. I thought this was such an interesting framework to look at wealth.
Yeah. And so these levels are based on your net worth. So just a reminder to your listeners, that's all your assets minus all your liabilities. So everything you own, cash, stocks, your car, your home, all those things, subtract out everything you owe, mortgage debt, credit card debt, student loans, etc. You get that, you net that out. That's hopefully a positive number, and hopefully it's a large positive number. And that's going to put you somewhere on the wealth ladder, right? Level 1, less than $10,000 in wealth. Level 2, $10,000 to $100,000. Level 3, $100,000 to $1 million. Level 4, $1 million to $10 million. Level 5, $10 million to $100 million. And level 6, over $100 million. The nice thing about this is if you just memorize level 3, which is what I call the middle class, which is $100,000 to $1 million in wealth. If you just memorize that, you can back out the rest by multiplying by 10 to go up a level or dividing by 10 to go down. And I came up with that because there's so many of these like different levels of wealth frameworks out there, and they're all over the place and they're arbitrary and they didn't really make as much sense to me. And so I actually looked at the data and I said, this actually, ironically, it's a very neat, logarithmic 10x scale, but it actually maps on to the U.S. households quite well. So for example, 20% of households in the U.S. are in level 1, which is less than 10,000. 20% are in level 2, 10,000 to 100,000. 40%, which is like your middle class, is in level 3, 100,000 to $1 million. And then 18% are in level 4, that's 1 to 10 million. And then the last 2% is just level 5 and 6, which is, let's just say, over 10 million. Because by the time you get to level 6, I think in 2025, there's like 11,000 households that have over $100 million. It's a very, it's a very long tail, and it's very few households that have extreme wealth like that.
Yeah. Okay. And so for each level, that can dictate, as we pointed out, how you spend money. Because I thought this was interesting, and I can't remember the exact how it lines up, but there is grocery store freedom, restaurant, travel. Walk me through the spending framework And I think you also had a rule. It was the 0.01 rule as well. Walk us through, like, how do you think about when you, based on the level you're at, how you think about the spending part of it?
Yeah. So the 0.01% rule is basically just says 0.01% of your net worth is a trivial amount. You can spend that on a daily basis and it's kind of trivial to you. And I can explain where I came up with that, right? So it's actually funny. Jay-Z had this lyric where he was like, what's 50 grand? I'm not going to say the exact lyric because he curses, so I'll just not curse. And I'll say, he says, what's 50 grand to someone like me? Can you please remind me? At the time, he had a net worth of about 500 million. So 50 grand to him was 0.01% or 1/10,000th of his wealth, right? So he's basically saying, hey, this is trivial. And it's like, oh, that's kind of interesting. What if I spent money based on this, like on my marginal spend, right? This is not your total spending, daily spending, or anything like that. This is like, hey, when you're going out to make a spending decision, you're like, hey, can I afford this thing? That's always the question, right? It's like, can I afford this thing? My question is, if that marginal spend is less than 0.01% or 1/10,000th of your net worth, and the answer is yes. And so in level 2, which I call grocery freedom, that's the net worth of $10,000 to $100,000. When you divide by 10,000, that means the marginal spending decision is $1 to $10, right? So when you're at a grocery store and you're deciding to buy an item, you're like, oh, do I get the eggs or the cage-free eggs? The difference in price there is going to be somewhere in that range, probably a few dollars, right? And so that's kind of the thinking. Like when you're going into a grocery store, you're making these marginal decisions on which item to get based on a certain marginal amount. And so my argument is, if you're in level 2 and as you get deeper into level 2, you have more and more grocery freedom. By the time you're in level 3, you have complete grocery freedom, right? And then when you're in level 3, that corresponds to restaurant freedom, right? So that's a net worth of $100,000 to $1 million. If we use the 0.01% rule, that becomes a marginal spend of $10 to about $100. So every time you go to a restaurant, you're like, oh, do I want to get the burger and it's like $20, or do I want to get the salmon and it's 30, right? There's that marginal $10 difference, and it's just allowing you to kind of justify that purchase. And it keeps going from there. Level 4 is travel freedom. Level 5 is what I call house freedom. And then level 6 is what I call impact freedom, because by the time you have $100 million, you can just really change people's lives in a big way with money. So I think the whole point of this rule, I know there's a lot of numbers and math. The whole point is I wanted to solve the problem of how do we allow some lifestyle creep without linking it to income. Because I think income, people, when you lifestyle creep with your income, it's a little scary because your income can drop, like you could lose your job, all sorts of stuff. I think by linking it to wealth, it's actually a better metric because your wealth's going to be a little bit more stable than your income over the long run. And so what this allows you to do is spend more money, but only after you've built the wealth. After you've shown financial discipline, then you can start to spend more. So like, hey, I made it to level 2, I can start to spend more at the grocery store. Oh, I made it to level 3, I can start to spend more at a restaurant, etc. And that's kind of the thinking behind this.
Mm-hmm. Wait, correct me. Was it the 0.1% rule?
I just say 0.01% rule.
Point
yeah, it's
zero,
technically
sorry.
0.01%.
Okay, I didn't want to botch it. I was like, 0.01% rule.
Yeah.
Okay, because I imagine too, like a lot of like, we don't really cover personal finance on this channel that much, but I bet like a lot of the advice is just probably like pretty bad out there. And I kind of like this framework. It really resonated too. You also mentioned like income. So many people let's talk about that. Because I imagine a lot of people do just live their lives based on income. Like I remember, like, okay, in my career when I'd start to get like a raise, my dad, who was amazing, would just say like, just because you're getting that doesn't mean you can start to live like that kind of lifestyle. Don't go like, basically it's like, don't go spend all your money just because you got a raise,
Mm-hmm.
Like, so how do you think about this challenge where a lot of people probably do just live off of income? And I think one of the things you point out in your book too is like, the higher your income goes, like the more volatility you can have like with your job. Cause I do imagine with job cuts, probably like those heavier salaries are the ones that companies can cut more easily.
Yeah, I think it's just for example, for high income earners, let's say you're making a really high income. If you lose that job, you're going to be able to find another job, but it's not going to be at that income level. And at least not initially. If you need to find a role that pays that much, like people really search. If you're making like 250K, 300, etc., like a lot of money a year, you're not just gonna be like, oh, I lost that job, let me just get another one. It's not that simple. Those types of roles are hard to come by, and it's going to take longer. Could you get a job at 150K? Probably. But like, that's the thing, is like seeing that large drop in income is something that a lot of people may not be ready for, especially at the higher end. the thing I think about income, I just like to, like, let's just use athletes as an example. And I know people always trash on athletes for how they spend money. It's not even about that. It's just like an athlete makes most of their money in about 5 years and has to last them like the rest of their life, right? So that's kind of the interesting part, because if you really think about that, even if they are saving, let's say 20% of their income, they're like, oh, that's good. You're saving a decent amount of money. But what happens in year 6 when that income dries up? Even though they save 20% a year for 5 years, that means they were spending the other 80%. And that 80% is a lot of money, right? So, and then they have to spend that 80% in year 6 when their income is zero or close to zero, right? Or maybe they just have a pension from the NFL or whatever it is, wherever sports league they're in. So my point is, income's a little bit fickle, in any given year, and, people lose jobs, it happens, and it's been relatively consistent. It changes over time. Obviously, during recessions, it gets a little bit worse, but like there is, job loss that happens. And so I just want people to think about the marginal spend and linking it to wealth. Of course, you have to spend based on your income. You can't spend everything based on wealth. You have to spend based on your income, but on the marginal decision, that's the whole question. No one in level 1 is saying, can I afford a Maserati? Like, they know they can't afford a Maserati. There's no debate there, right? People in level 1 are saying, oh, can I afford this thing? Or people in level 2 are saying, can I afford this thing? That's the moment where this rule kicks in. It's not over every spending you do. It's like on the marginal decision. And that's how I want people to think about it.
Yeah, that's why I like that rule too, of like kind of know like where you can. You're not saying don't spend. It's like, okay, know where you can spend based on that level. So the restaurant freedom, for example, but I'm not at the level where I can have like the travel freedom where I can stay in like the 5-star hotels or like upgrade to first class every single time either. But I like the framework. It seems like easy to remember as well. This is kind of that classic question that everyone always asks when you have written a book, the reason why you've written it. But maybe what I've kind of learned from reading the book is you've kind of been at a number of these levels, or maybe we can even go back and talk about like your own experience of being at various levels and where you are today.
Yeah. So I would say even though my parents declared bankruptcy twice before I was 18 and they divorced when I was 6, it's a kind of a long story, but though that happened, I don't think I've ever been in level 1, because I do count things like family and network and like intangibles a little bit in how I think about this. Like, I've never been in abject poverty. Like, yes, money we didn't have a lot to go around. I was always eating off the dollar menu at McDonald's, for those that remember that, or the value menu. It used to be called the dollar menu, then became the value menu. And, so I was used to that type of lifestyle, which I would say like lower middle class, working class, however you want to call it. And I was even after I graduated from college, I still even though my personal net worth was less than $10,000, I still consider myself like in level 2 if I have to look back, right? But going from level 2 to level 3 and eventually to level 4, there were a couple key decision points that had to kind of come up. And I didn't know this at the time. I didn't have a framework for this. Only after the fact did I come up with the wealth ladder as a framework, which have been helpful for thinking about this, right? And so like, for me, like the first thing was like, hey, I had to get the education. I had that. That was helpful from getting from level 2 to 3. And I think even just that alone, I would have got to level 4. It would have taken me a bit longer. I think my original projections in my 20s, I know this is crazy, but this is how I used to think. I was supposed to reach level 4, like basically $1 million, sometime by, I was like 47 or 48, right? And so that was my guess of like everything. And I was making very conservative assumptions on returns and savings and all this different stuff. I got there a bit earlier because I started this side thing I did, which I was writing on the internet, and I did it. And I was posting blogs for, 3 years, didn't make any money, just posting it because I loved it and just did it and did it and did it. And then monetization came, and then I wrote the first book, Just Keep Buying. That did really well. And now I have the next book. So it's just been a slow process, but I've been at this for 9 years. And so I know a lot of people are like, I say, hey, you need to raise your income, but like it can take years before you start to see real results. And like I did this for 3 years and got no payoff from it, except like just the praise that people gave me. And there is something to that. But I think a lot of this is thinking through, okay, hey, my job was great. It was paying me well, my old job, but I couldn't see a future in that. So I had to come up with something else for myself. And that other thing was me writing and putting content out on the internet. And so I'm not saying that's what you have to do, but there are other options out there. And I kind of talk about some of these options in the book.
No, I love that and doing it because like you committed to it. I think maybe it was a New Year's resolution if I recall, but you committed to like every Sunday putting out the blog consistently. And like you said, you started in 2017. It took a few years, I think, until 2020 when it really took off. Also, like that probably brought you to like Ritholtz Wealth Management, or like connecting with those guys, Josh Brown, Barry Ritholtz, Michael Batnick, like a number of these guys that we've had on the show as well, or trying to get on the show. Hello, Barry. We definitely want Barry on the show at some point.
I'll get Barry on the show. I'll talk to Barry.
We're gonna have him on.
I will get Barry on the show. He would love it. His new book's great, so he will love to come on here and talk about how not to invest.
What I love about Ritholtz and Callie, I went to school with her and we worked at Business Insiders. Like all the content that you guys have done, that to me, like I love doing this podcast, and like we're not making tons of money doing it. I do it for the craft. Like at some point, yeah, it's kind of like a side hustle right now, but at some point I would love to like go all in and go like full time doing it. But it's something about just showing up. Even I was telling Matt, our producer, like there's some days like I don't want to, or I'm tired or whatever, but it's just showing up week after week. But talk to me about the one, maybe the commitment to doing that, but the opportunities that opened up for you as well.
Yeah, so it did open up because of the blog, Josh and Michael. Like Michael, it's so funny. Michael Batnick was like an information fiend. He was out there reading everything. Michael Batnick was one of my first 20 followers on Twitter. Think about that.
Whoa,
how many people he somehow found my blog before anyone else ever did. I had maybe 3 or 5 friends that were on Twitter at the time. I didn't have a ton of friends on Twitter. So I had like 5 followers, and slowly within a few weeks, I'm posting. No one knows who I am, right? And within like a few weeks, Michael Batnick's one of my followers, which was insane, right? So like that to me was huge. And then obviously, I talked to them about other stuff I can do, the data science work. And so I kind of do ops there, and that's why I'm the COO there now. It's just a long kind of journey, but it was this process of just like talking to people on the internet, meeting people, reading their work, promoting their work. I've been promoting people for so long, it's crazy, and people have promoted me. So it's that's just how the creator economy is. Like if you like someone's work, you'll promote it, right? It's so crazy. Like I still remember when I remember reading Kyla Scanlon's very first article about I think it was like rideshare or Uber or something to do with cars, and it was the car economy. It was very good, and I promoted it. And now she was just on the Daily Show with Jon Stewart, and it's just
amazing.
Great. I'm not saying that's because of me. She was amazing before me, obviously. I'm just saying it's cool to see that progression and to see people succeed in such an amazing way. And that's the type of opportunities that open up when you just put yourself out there and just keep putting out work consistently. And it's truly incredible to watch.
Yeah, no, I find it inspiring too. And I remember like Josh Brown, the way he was able to connect with Barry too. He was like, also publishing content too. And I think, scrounged together some money to go to a conference so he could connect with him. It's inspiring too. And it just reminds you, like, keep going, keep putting out great content. Let me ask you this too. You also talked about, well, maybe I'll go back to like your time at Stanford. What was that like, the experience at Stanford? And did that kind of shape the way that you were able to like look at money? I imagine like maybe it was a different experience too. Like would love to kind of revisit that time. And then you talked about like even right after Stanford, what was it? Charlie Munger was like, you better get your first 100,000 and get it fast. Like even if you have to like walk or whatever it was, it had that great quote. But talk to me, maybe did that experience also shape the way you thought about money or wanted to attain success?
Yeah. So at Stanford in particular, I think for me, it was more eye-opening. It was the class difference in terms of like, I said I grew up kind of working class family, and now I'm here with people in the middle class and a lot of kids in the upper middle class, right? And so like, I remember like in my freshman year, most of the kids in my hall had been to Europe. Remember, the school's in California, so Europe's obviously like further away, and half the kids are from California at Stanford, just like many of the other California schools. So it was one of these things where it was very eye-opening that like, there's different levels of wealth, and understand. I meant that very colloquially at the time. Now I have an actual levels of wealth framework, but like it was just eye-opening, and no one like treated me badly or anything because of that. Everyone was very nice. I'm not saying this is like, upper middle class kid. No, it wasn't that. It was just interesting to kind of see the differences there. And like, a lot of the international students in particular, they aren't need blind. Like all the US domestic students, they're need blind. So if you're poor or not, you can still get in regardless. International is not need blind. So a lot of these people probably had a lot of money and paid full price, right? That's just how they do things. But it was interesting because now you have people where, someone had a 21st birthday party, and they got buses to bus in a bunch of people in and out of Stanford down to like a local bar in Palo Alto. And they paid for all of that, right? You just had to show up and get on the bus, right? So these are things that are like, seem insane to me, but like, that's what some people had the money to do that, right? And so it was just interesting kind of mingling with those people, but it was very helpful for me because a lot of those people taught me on like how to do certain things. How do you build a resume? Oh, you need to talk to these people, or you need to get in these clubs. You need to do this type of stuff and get these internships. And like without that, I wouldn't be here today. So as much as there's no hate there. It's just interesting to kind of see the differences. And it did help me a lot because of those connections. So that was like one of the biggest things I saw. In terms of the Munger quote, the 100,000, I was just trying to I had some arbitrary goal in my head and said, hey, I just really need to get to there. And then they say the compounding takes off from there. It was partially true. I mean, at the end of the day, like, market returns were positive during that time. I started investing in 2012. I had a decent job, was saving good money, but it just progressed from there.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold, paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. As you pointed out, I think in the book, you're level 4, right?
Yeah.
Okay, you're level 4. It's all good. And you also talked about it takes a typical millionaire household over 30 years to build their wealth. Only 5% of them do it before age 40, which is quite impressive. Okay, so talk to me about I guess for folks probably watching this channel, based on what I understand about them, most are probably going to be level 3 and above. So how do you think about progressing from one level to the next one? And maybe we could start with like level 3.
I think the big thing in level 3 is investing. And so there's like a catch line for every level, and level 3 is just keep buying, which is ironically the title of my first book. And I believe that because when I wrote that book, that whole idea was like, hey, this is the best solution for most people. Like you have a good job, you're saving some money. What do? You invest it and you give it time and you get into level 4. That's kind of I didn't call it level 3 and 4 in that book, but that was the thinking. Now for level 4, it's a completely different game because that framework, just keep buying, will not get you into level 5, right? Unless you have an incredibly high income, like you're making $1 million a year or more than that, you're not going to get to level 5 by doing that unless you just wait a really, really long time, right? So if you do the math on it, it's actually pretty obvious. For example, assume you have $1 million portfolio today, you're earning 5% a year, you're saving $100K a year. Do you know how long it takes you to get to 10 million? The answer is 28 years. So it's 28 years of grinding, saving $100,000 after tax after you already saved up $1 million. Yeah. Right. So that's like a huge, and then even if you're saving 300,000 a year, which is a ton of money to save, right? 300K, it's a ton of money. It still takes 17 years with the same assumption. Start with $1 million, 5% a year. It still takes 17 years. So the realization I had for those in level 4 is you're not going to get out of level 4 without a drastic change in strategy, right? It's like there's that famous business book by Marshall Goldsmith, What Got You Here Won't Get You There. And that's the same thinking. And so how do people get to level 5? It's mostly, besides like celebrities, athletes, entertainers, it's mostly going to be business ownership. It's entrepreneurship. And so you have to own you either have to own a company that sells for tens of millions of dollars, or you have to be at a startup and have a small piece of equity for a company that sells for hundreds or maybe even billions of dollars for you to get into level 5.
It's interesting with your book. Okay, so just to reiterate for folks, the level 3 is 100 to $1 million, 100K to $1 million. Level 4, 1 million to 10 million. Level 5, 10 million to 100 million. And level 6, 100 million and above. It's interesting because the book is a bit of a guide on, progressing through the levels, different strategies. You kind of have this analogy to chess, like learning how to play chess, and you had to changing strategies and all these things. So it's a bit of a guide, but is it also fair to say that it's a bit of a warning because maybe the final goal is not necessarily to get to level 6 either?
Yeah, and I kind of say that in the book. I say it's a guide and a warning, because it's a guide like, hey, here's how you can do it, but it's a warning in the sense of at some point you have to say, when is enough enough? And I think for most people in the US, that point is level 4. Where in level 4, I don't know exactly, but I think in the US it's level 4. I think internationally, where cost of living is cheaper, I think it could be level 3, especially like in Europe where there's a bigger social safety net, etc. But when I think about these types of things, I'm thinking about like, okay, what are the costs of getting into level 5 and level 6? And what are some of the trade-offs you have to have? And because it's not all upside. And I know, trust me, this is the world's tiniest violin again. Oh, people in level 5 have problems. I don't care. But like, they can have many different issues that money won't solve, unfortunately. It could be health issues, relationship issues, all sorts of things where money's not going to solve your problem. And so I think that's a good thing to keep in mind regardless of your wealth level, but that's the stuff I focus on in levels 5 and 6, because I know most people aren't going to get to levels 5 and 6, myself included. So when I talk about those levels, the thing I'm talking about is all the non-financial aspects of your life, right? And so I use, Sahil Bloom's 5 types of wealth framework. That's kind of a way of thinking about this in terms of, hey, what are the other things I should be focusing on and why should I be focusing on them?
Yeah. As you also point out in the book, like a lot of times people talk about, I don't know, they talk about wealth and they talk about happiness. And you talk about like, when we think about money and happiness, the relationship isn't a linear one, but a logarithmic one. Can you elaborate more on that?
So in general, like going from zero, I can just say this very simply and you'll understand it. Going from $0 to $10,000 is a much bigger jump in happiness than going from 1 million to 1,010,000, right? If you have $1 million, another 10,000 is not really going to do much. Going from nothing to 10,000 is a massive jump, right? And so what's happening is over time, there's like this diminishing, marginal utility, like the happiness you get from more money goes down. You need a larger and larger amount of money to see the same jump. And it's maybe not I don't know exactly where the number is. It could be a 2x, 5x, 10x. I don't know. But you need a multiplicative amount more. You need to multiply your money upward. And so the wealth ladder is obviously using a log base 10. So I'm saying a 10x jump. I don't have data that shows exactly where that would be. But in general, like you need large jumps in wealth to see happiness boosts. And happiness does. And so I do talk about happiness in the book, and there's a lot of studies on there and I summarize them. But the main summary is if you're happy, more money will make you happier. If you're poor, more money will make you happier. But if you're not poor and you're not happy, more money won't do a thing. That's the main summary of all of the research that's out there. And it's very clear. So a lot of the people that say, oh, I'm not really happy. Oh, maybe I just need more money. That's actually not going to solve their problem. Unless they're poor, unless they really just don't have a lot of money and that's the reason why they're not happy, it's not going to do anything. So once you're in level 3 or level 4, if you have some level of unhappiness, it's not money that's going to solve that. Just like it's very clear to me in the data that it's not money that's your issue. It's something else going on and you need something else that's going to get you there. I think if you're in level 1 or 2, money could be your problem. But I think by the time you're in level 3, it's definitely not the issue.
Yeah. All right. Let's go back to the investing side of things. So you mentioned like level 3, one of the things you need to do is follow that just keep buying framework that you highlight in your first book. I want you to maybe even, okay, I'm trying to think how I want to phrase this. Like even at all-time highs, like when we see stocks hitting fresh all-time highs, talk to me about the framework of just keep buying regardless of the environment that stocks might be in.
I think you just have to follow a set of rules and just follow those rules and not really think about it too much, and like I've done things, for example, I own a small percentage of Bitcoin. I have a certain percentage range in my portfolio that I've always owned. One time, back or in my early days, Bitcoin had a big run up. It got too high. I sold some of it, not because I thought the price was going to crash, not because of any of that. And it did eventually crash. And I looked like a genius, but now it's gone way beyond where I sold it from. Now I look stupid. So it had nothing to do with any of those things. I'm doing a regular rebalancing. I'm doing it consistently over time. And that's it. And just like I buy stocks and I wait. That's it. Because I'm thinking like, is the stock market going to be lower inflation adjusted 30 years from now compared to now? The answer is probably no. I will continue buying over time, and we will let the chips fall where they may. And I spend most of my time focusing on the things that I can actually control. I can't control the S&P 500. I can't control monetary policy. I can't control foreign investor flows. I can't control any of those things, right? I can control obviously what I purchase, but if I just keep purchasing a basket of globally diversified securities, I think the world on average will do okay, barring no nuclear events or any of those types of things, global wars. I'm hoping that doesn't happen again. And if it does, we have bigger problems in our investment portfolio, right? So it's only an upside bet, right? There's really like no downside to this bet, right? The downside is, what if there's a global war? Who cares about your investment portfolio? Do you have canned goods and ammo and medicine? Like, if you don't have that, then you should be, if you're really that worried, you should have all that stuff. You should have 1% of your net worth as a prepper, right? If we really want to go there. So it's only an upside bet. And I just keep buying. Well, stocks have higher valuations. Well, yes, also stocks have changed. They're very tech based and, the most profitable companies in history. And things have changed over time. So there's a problem with the valuation metrics of the P&E ratio isn't measuring the same thing as it was historically. We don't have railroads and stuff like it was in the early 1900s. Like, business has changed. How business is done has changed. And scale is, because of the internet, is a lot easier now. So these companies are more profitable and they should be bid up accordingly. And so whether they can still be in a slight bubble, it's still possible. But where's the right amount? I don't know. And so I think just realizing that things change over time and ignoring it and just keep buying and make sure you're diversified, right?
I think that's such an interesting point too, like the being able to ignore it, because you even talked about, like, in the book, like 2022, you saw like your holdings go down, but obviously you held, and like things have certainly rebounded. Talk to me about the ability to ignore. Did you learn that? Like, was there a lesson along the way? Just curious.
I mean, I just study a lot of history.
Okay.
Like, the more I think market history, I'm not saying, trust me, the future is not going to be exactly like the past, but it's going to rhyme, right? It's that Mark Twain, or whoever, I don't even know Mark Twain said it. Someone said it, right? And they just attribute it to Mark Twain. But I really believe the more history the more you're going to see this stuff over and over. And it's just the same kind of stuff over and over again. Human nature hasn't changed all that much. And so it's like, I'm saying this, besides a few individual stocks, ignoring those, I've never sold an index fund in my life besides typical rebalancing. That's it. I've just kept buying. I literally mean that. Like, I just never sold anything.
Yeah.
And that's going to be my goal going forward. Like, yes, there's going to be a 10-year period where US stocks underperform like a lot of other asset classes. That is going to happen. I don't know when. I don't wish it upon anybody, but it's going to happen. It's going to be rough for everybody. We are going to get through it, though. I promise you. We got through COVID, as bad as COVID looked, right? Obviously, there was monetary policy that helped there, but I think we'll get through these types of things. And so I just ignore it. I literally just keep doing the stuff, and I focus on what I can actually add value at. That's what I think most people should be doing, is focus on what's your edge in the economy, not what's the economy doing.
Yeah, that's a good point. Okay, what about tell me about the Bitcoin bit. Why do you own Bitcoin?
The mantra from Just Keep Buying is the continual purchase of a diverse set of income producing assets. So the vast majority of my assets are currently about 95% are income producing, but 5% are not. So that includes things like gold, art, Bitcoin, etc. And I own some of those things because, I have a small percentage in them, and who knows what's going to happen to them. And it's a hedge. And of course, it's not a large hedge. I can't imagine a world where the S&P 500 goes to zero and Bitcoin is still around. I just can't imagine it as a concept.
Like a little apocalypse hedge or something?
I think in the apocalypse, Bitcoin goes to zero too. I just, we don't have compute running or whatever. I mean, there's different ways the apocalypse can play out, but we saw it in 2020 was the best version of this I've ever seen, which is like, I was watching the ticks in March, and I saw it going down, 8,000, and then it was down to 3,000. And I was like, is it going to go to zero? I'm like, I'm literally watching the ticks. I'm like, this thing is about to go to zero, and someone bought or something and prevented. I can't remember how low it got, like $3,000 a coin or something in March 2020. And it was crazy to watch that in real time. And it didn't go to zero, and now it's $120,000.
Yeah, what is it? 120.
Yeah. It's wild how crazy that's been. But it is a high of all asset, and it's a high beta asset in the sense of, if the S&P 500 is absolutely cratering, it's going down too. I've not seen a case where it's been decoupled. There's moments where it's decoupled, like, the S&P is down 3%, but Bitcoin's up. But it's never like S&P is down 30% and Bitcoin's up. Like, I have not seen that yet.
Yeah. See, you're not, and obviously you mentioned like the little lesson of like selling and then it's like, oh, dang it, rebounded. You only really sell when you have to rebalance. You're not a seller. I'll tell you this, like, I'm not really a seller either. And I bought gold. I won some money from like some entrepreneurship contest stuff, like when I was in school and undergrad. I bought gold, I want to say in like August of 2011. So it was a peak and then it was down for a long time. And I just ignored it until earlier this year. I looked at my statement from my brokerage and I was like, okay, like it's definitely rebounded and then some because I didn't touch it. I mean, I would never looking back, like put all my money in gold right out of college. I would have probably, I wish I bought some stocks like index funds, but I learned a lesson and I just didn't do anything with it and it was fine.
Yeah, I think that's the key is like figuring out what's a good mix for you. And for some people, it's going to be more crypto or more gold or whatever they see fit.
I own more stocks than I own gold, but at the time, that's what I did.
Yeah. No, it makes sense. And so it's just figuring out what's the portfolio for you. And I'm not saying, oh, you can't only have 5% in non-income producing. You can have 10, 15, 20, whatever you want. That's just, I recommend anywhere from 5 to 15%. I don't think anyone should have zero non-income producing, but it's really up to them. And, at the end of the day, like what's the reasoning for this? Everything's based on what people are willing to pay for. That's true whether you're talking about income producing or non-income producing assets. But with income producing, at least there's this fundamentals of like, hey, there's this profit in this business that's a real thing that is more tangible to me than just like, oh, a rock or a digital, on this digital ledger that says I own this digital thing, right? It feels more tangible to me. And that's why, just like some people like real estate, because it feels like a real thing, and stocks feel like this fake paper ownership of whatever, right? And so everyone has just different preferences.
Yeah. Well, Nick, I love your book. It is a great read. I'm going to link it for folks who are watching and listening to pick up a copy. And before I let you go, let's leave this audience with some parting thoughts. Anything that you would like to leave them to think about. The floor is all yours.
Yeah, so I think one thing we didn't touch on as much as I have in some other interviews is the importance of income and income across the wealth ladder. It's like the most correlated thing. Like if you look at, I think it's the second chapter in the book has a table which shows like by wealth level, what's the median US income. And that is like very indicative of showing like, oh, wow, it really is income that drives wealth accumulation. And then it becomes a flywheel where the more wealth you have, and if it's invested in income producing assets, it produces more income, et cetera. I think it's like page 20.
Is it
25? Page 25. Yeah. So there's this table here, and you can see it. Maybe you can, you can blow
there
it
go.
up there. Yeah. I don't know if you can take a picture there, but the table basically shows like by wealth level, what's the median US household income. And so in level 1, it's 32,000. Level 2, it's 47,000. Level 3, remember level 3 is the middle class, kind of 100K to $1 million. It's 83,000. Level 4, which is 1 to 10 million in wealth, it's about 200,000. Level 5, it's 724,000, and then in level 6, it's $4.3 million. So that's the median household income by level. And I think understanding the importance of income and over long periods of time that's the pillar, or that's the lever you use to build wealth. So just something to touch on.
As you put it, that your income today is the foundation of your wealth tomorrow. It is the bedrock on top of which everything you desire financially will be built.
Yeah, that was better than what I said, but hey,
no,
I wrote that.
You did write that.
I'm not as good. I'm not as good when I'm just freestyling here. So the writing's a little bit better.
I always have fun talking to you, Nick.
Yeah,
and I want to say congratulations again on the book. Nick Maggiulli, author of The Wealth Ladder, COO at Ritholtz Wealth Management, and creator of the Of Dollars in Data blog. Really appreciate you taking the time. Great to see you. And congratulations again, Nick. Thanks so much.
Thanks again, Julia. Appreciate it.